what a big news week for the real estate market and the economy overall. Let's break it down. Of course, the biggest headline of the week was the Fed meeting that took place Tuesday and Wednesday. And of course, the biggest market mover from that event was the press conference from Fed Chair Jerome Powell on Wednesday afternoon. So the Fed raised the federal funds rate by 25 basis points or 0.25%. Now, that was as expected. Now, remember, markets love predictability. Now, Jerome Powell in his press conference also indicated that the Fed might pause any future rate hikes to let things play out. And the bond market, which directly influences mortgage rates, loved that. But then today, we had the Bureau of Labor Statistics jobs report come out that showed a whopping increase of 253,000 jobs created in April, which blows away the estimated number of 180,000 jobs that were expected to be created. Now, I think there's more than meets the eye to this report because it also had revisions from the previous 2 months. And those revisions took away a combined 149,000 jobs created in the previous 2 months. So I fully expect something similar to happen in next month's BLS jobs report. Now, also to note in today's report, the unemployment rate decreased by 0.1%. Now, I personally think that's largely due to 43,000 people getting out of the labor force entirely. So if you look into the report, the labor market might actually not be as strong as it seems, but it doesn't really matter because investors react to the headline numbers, and that reaction was not favorable to mortgage bonds. So why the back and forth? Why do certain things do good things for mortgage rates and other things do bad things for mortgage rates? Well, let's zoom out for a second. So mortgages don't just exist to help people buy homes. They are investment vehicles, and people invest in mortgages in mortgage-backed securities, otherwise known as mortgage bonds. Now, mortgage bonds are typically considered some of the safest investments that you can make because they go into shelter, right? Shelter is a component of life. You have to have somewhere to live, and people traditionally will make sure that those mortgages get paid on time, and so that interest is collected passed on to the investor. Now, two primary drivers of the value of these bonds are inflation and economic strength. In times of high inflation, money in the future will not be worth as much as money today. So as an investor, why would you want to invest in a long-term fixed rate mortgage bond when the money you get during that long term is not going to be worth as much as money that you'll get now? So this is why banks need to up the interest rates on mortgages a little bit to make the bonds more attractive for investors to buy, right? Because a higher interest rate will kind of cover the money that the investor will lose due to inflation. Economic strength typically comes into play in times of recession or when a recession is feared. And that's because as an investor, if you fear a recession and you think that companies' revenues are going to be less predictable or just flat out less, you're going to look for a safer investment. And bonds typically provide that safe haven of investment. And so as investors are pouring into mortgage bonds, banks also don't need to charge as high of an interest rate to make a good return on those investments. And so that's why during times of recession or when a recession is feared, mortgage rates typically will pull back. To recap, for these reasons, when inflation or fear of inflation is high, mortgage rates will go higher. And when there is a recession or fear of a recession, mortgage rates move lower. Now, let's bring it back to this week. So when the Federal Reserve raises the federal funds rate, it makes the cost of borrowing money more expensive. And so companies, it makes it harder for them to be as profitable because the borrowing costs are so increased and that eats into their profits. So investors, to them, that's a sign to fear a recession. Okay, and so investors will move into mortgage bonds, which should lower mortgage rates. Now, I want to be clear, the federal funds rate does not directly impact mortgage rates. It's really more about what it does to the overall economy and the reaction to it. On the flip side, when we see a smoking hot jobs report and a declining unemployment rate, those are signals of a high inflationary environment. Well, we already know that we're in a high inflationary environment. So when we still see those things in spite of the high inflation that we're in, to the investor, it says, oh, wait a minute, now we need to fear inflation more. And so they pull back mortgage bonds or not as attractive of an investment. And so mortgage rates might go up a little bit. Now, everything I just described happened over the course of a couple of days, not months, but a couple of days. And so that's why mortgage rates can and have been very volatile. And that's why timing the interest rate market is nearly impossible. This is why I would personally rather focus on monthly payment rather than the interest rate when it comes to advising clients. So interest rates are just a tool to accomplish a bigger goal. And for my context, that bigger goal is helping people get into a house. And by the way, we have more tools in the toolbox than just the interest rate to make it work. Believe it or not, we only scratched the surface of everything at play in regards to the economy. But I hope I pulled back the curtain just a little bit to show you the nuts and bolts of what's going on, specifically in regards to mortgage interest rates and how and why they are moving. That being said, drop a comment with any other questions you might have and have a great weekend.